This is the one video I'd tell any beginner investor to watch before opening a brokerage account. Index funds are boring, and boring is exactly why they work. Today we're covering what an index fund actually is, why fees matter more than people realize, and how to build an entire portfolio with just 1 to 3 funds. An index fund is a basket of investments designed to track a market index rather than trying to beat it. An S&P 500 index fund, for example, holds all 500 companies in that index, weighted roughly by company size. So you own a small slice of Apple, Microsoft, and 498 other major U.S. companies in one purchase. Because there's no analyst team trying to pick winners, the expense ratio, the annual fee charged as a percentage of your investment, is dramatically lower. A typical actively managed fund might charge 0.5 to 1% annually. A comparable S&P 500 index fund from a major provider can charge as little as 0.03%. On a $50,000 investment, that's the difference between paying $500 a year and paying $15 a year for exposure to largely the same market. Here's the math that makes this urgent, not just theoretical. Invest $500 a month for 30 years at an 8% average annual return. In a fund charging 0.03%, effectively you keep essentially all of that return, ending with approximately $745,000. In a fund charging 1% annually, your effective return drops to roughly 7% and the ending balance falls to around $611,000. That's a $134,000 difference purely from a 0.97 percentage point fee gap, assuming identical underlying performance. Fees don't feel dramatic year to year. 1% sounds small, but compounded over decades, they quietly consume a huge share of your total return. You don't need 20 different funds to be diversified. A common, simple approach. A total U.S. stock market index fund for broad domestic exposure, a total international stock index fund for global diversification, and a total bond market index fund for stability, adjusted by age. A common rule of thumb is holding a bond percentage roughly equal to your age, so a 30-year-old might hold 20 to 30% bonds and 70 to 80% stocks, then shifting more conservative over time. Target date retirement funds do this rebalancing automatically for a slightly higher fee, often still under 0.15%, and can be a genuinely reasonable one-fund solution for people who don't want to manage allocation themselves. Opening an account and actually buying these funds is simpler than most people expect. The major providers, Vanguard, Fidelity, and Schwab, all offer their own zero or near zero expense ratio index funds, and I've linked account setup guides for these in the description. Fidelity, for instance, offers a few zero expense ratio index funds outright. The specific provider matters less than actually starting. The biggest cost of waiting isn't a bad pick, it's the months or years of compounding you don't get back. Recap. Index funds win because they charge dramatically lower fees than actively managed funds, and most active managers don't beat the index over the long run anyway. A 1% fee difference can cost you well over $100,000 over a 30-year investing horizon. 3 funds, U.S. stocks, international stocks, and bonds, or even one target date fund is enough for most people to build a genuinely solid portfolio. If this made investing feel less overwhelming, subscribe, because next week we're getting contrarian with why the 50-30-20 budget rule doesn't actually work for most people, plus a free budget template. Brokerage account links are in the description.